all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 131st CP program organized by AASP of ICI. Today we are organizing 131st CP program of this particular council year, and this topic is very important. That is the key considerations in audit of NBFC. And in order to tackle this very important topic, we are having with us CA Shri Ganesh Balakrishnan ji. So on behalf of AASP of ICI, I extend my warm welcome to you, Ganesh ji, for sparing your valuable time. And in spite of having your busy schedule, as well as in the overseas, and it is the early morning around 6:20 a.m. and you are ready to deliberate. And when I approached you and you have committed that at the particular time you will be outside India, and at that particular time there will be a 6:15 or 6:20. So I hats off to you, sir. And once again, thank you so much, sir, for acceding to our request. And in early morning, you are ready to for our members, and always you are ready for our members, sir. Thank you so much, sir. So before I start, so I would like to share with all of you the brief profile of our today's learned speaker from our own Chartered Accountant fraternity, CA Ganesh Balakrishnan ji. CA Ganesh ji is the office managing partner of Deloitte Haskins and Sells, Hyderabad office, and is in the audit and assurance practice with 3 decades of experience. Ganesh ji heads the talent and learning and development of the South Asia cluster of Deloitte and audit function. Ganesh is part of the IFRS faculty with the Institute of Chartered Accountants of India for the 3 in-house and open house programs, and serves as a faculty of Dun and Bradstreet for their programs on IFRS and US GAAP. He is associated with the Quality Review Board and Peer Review Board set up by the Institute of Chartered Accountants of India. He is also the regular faculty of Board of Studies for Institute of Chartered Accountants of India in imparting web-based lectures like webinars, as well as the various certificate courses online, as well as other virtual CP meetings for the students and members. He is presently associated with Dr. B.R. Ambedkar College and B.R. Ambedkar College, Bhavans Vivekanand College for review of syllabus on accountancy and commerce. He has undertaken IFRS training for Osmania University faculty. He is an external member to the School Board of School for Management Studies of University of Hyderabad. He has presented papers in various forums in India and internationally at universities and other professional bodies on impact of the technology on future of accounting, US GAAP and IFRS. Ganesh is also a motivational speaker and speaks regularly at UGC, HRD, Women's College, OU, and other colleges and universities in India. He graduated from Osmania University and is a fellow member of the Institute of Chartered Accountants of India and a cost accountant. He is also a certified public accountant CPEA from the American Institute of CPAs. Still, list is very vast. So without wasting much more time, I request our learned speaker, CA Ganesh Balakrishnan ji, to please enlighten all of us on various intricacies and key consideration in the audit of NBFC. Over to you, sir, please.
Thank you so much for the introduction, and I really appreciate it. And for me, I am what I am is only because of the institute. So therefore, there is this gratitude for me, which will continue for years to come as long as I'm in the CA practice. So I will continue both for the members as well as for the students, and that's my responsibility. Thank you very much. And I do understand, this NBFC is a pretty vast subject, and it's not something that we can cover within a short period of time. But what I put it across is just to make sure that everyone understands. So basically what is important in today's world, and just to give you a background, as early as January 2023, the RBI has come up that they're going to conduct a special audit on more than 9,000 NBFC companies. And just imagine why this is very important is that if you see between 2015 and 2022, there were about 3,000 odd companies which NBFC licenses were either cancelled or where there were questions asked. So the question here is that as an auditor, I mean, again, if you were to look at for those 3,000 companies which are the NBFC, which could have covered under various categories of non-compliances, what is important for all of us to understand is in today's world of being regulated, it is important that we look at every circular, and I'm again I might have missed out in many of the circulars while I'm doing a presentation, but when you're carrying out an audit of any NBFC, make sure the first step, what you have to do is to get the complete download of the entire circulars issued by the RBIs. If it's a listed company, make sure that you have the entire information downloaded from SEBI. If it is related to the Schedule 3 Division 3 applicability, Schedule 2 Division 3 applicability, make sure that you have the entire Companies Act information with you. Why I'm saying this is very important is, even before you start an audit of NBFC, what is important is what are the applicabilities, laws and regulations. Unlike in a CA, unlike if you see in case of a tax audit and all of that, where you generally get upgraded or updated on a regular basis, especially when we do an audit and of such a magnitude, which the RBI has also come back in terms of restrictions, in terms of the number of audits that you can do in that particular entity, and with a cooling period of almost 6 years, which is 2 consecutive years of 3 years. What's important for all of us is to be cognizant about the changes that are expected. With NEFRA being there and more, the Companies Act and the regulators look at us to report on 2 aspects of it, which is very critical. One of the aspects relates to fraud, and again, re-emphasizing it relates to fraud. No longer we can go under the premise saying that that auditor's responsibility is not towards fraud. Our whole objective, a whole issue which has come back, is that auditors know more than anybody else. So therefore, the primary focus have now moved from just an audit of any entity to focus areas of audit, whether it is a misstatement due to fraud or error. And the other important aspect that has been brought in very much is in respect of related party transactions. Leave alone the compliances that are required under the capital to weighted asset risk asset ratios, the CRAR, or if you were to look at the scale-based regulations, the SBRs. Think through these aspects of it much more closely. So therefore, engage with your clients. The difference between an NBFC and a bank is bank normally has got the demand deposits, whereas in respect of it, you cannot have demand deposits. You could have public deposits or term deposits under NBFC. Important for us is merely because we have experience in respect of carrying out a bank audit does not mean that we would be able to apply exactly the same for the non-BFA and for the NBFC. So important for all of us, for everyone, including me, that we should be having the updated information relating to all these circulars and regulations. Again, an NBFC which has been in existence, whether it is under the Companies Act 1956 or the Companies Act 2013, it basically deals in giving loans and advances, acquisition of shares, debenture, bonds, leasing, etc., and all of that. And they play a major role. See, unlike a banking industry which requires stringent norms, NBFC are far more easy to manage in terms of regulation, while it is still regulated under the RBI norms, but it is easily manageable from a perspective that the compliances, and it is where the funds are accessible. If you really were to look at it, going to a bank versus going to an NBFC, it is easier to get money from an NBFC than going to the bank because the norms are much, much more stringent in respect of banks. So therefore, the NBFC plays a very, very vital role in the Indian economy. And this is predominantly when somebody talks about an NBFC, we talk about the traditional equipment leasing or hire purchase and all of that. That's exactly how it will be that the NBFC would look like. And in fact, there was this, before this fallout of, some of the, the era of where this to be flush with income tax giving less than 5,000 full depreciation. NBFCs really flourished during that period. And I think during the 1990s and 2000s, early 2000s, they really flourished during that period and before. And especially, again, they were driven more from a tax benefit with this one. So lot of the bankers moved from companies to this so-called this NBFCs and all of that. Important for all of us to know is there is a distinction between the banks and the NBFC, and it is important for all of us to be cognizant about it. First and the foremost, as an auditor, what is expected of us? And the first and the foremost of an auditor is what is the scope of the audit that we are planning to do? It is not a checklist driven. That's something which we need to be very, very clear about it. We need to definitely have the knowledge. Again, the knowledge is you could have information that can come through a credit rating agencies. You could have reports from the Reserve Bank of India of each sectoral, how they're performing, whether it's a sectoral relating to automobile, it's related to, let's say, consumer durables or electronics or any such matter, FMCG, how each of these businesses are doing and what are the exposures other than the banks than in NBFC has got. Not necessarily that they get covered under the priority sector, but definitely the sectorial understanding of the business is very important because for the NBFC, the primary is lending. The money is what matters most. So therefore, understanding of that becomes critical. The second thing which is important, as I've been talking in the beginning, also the considerations of the laws and regulations governing the NBFC. It's very, very vital and very, very important. So therefore, make sure before you get into, and also make sure that there are significant assistance provided by the ICI. I mean, the WSB provides regular updates on the changes in respect of certificates, what are the things that needs to be done. So make sure that you have an understanding about the role and requirement, whether it's a 45IA, which is required under the RBI Act, if it meets more than 100 crore for a CIC. So these are some of the things which becomes very, very essential. Also important, similar to the audit of any entity which is non-banking, here also it is important is the nature of the timing and the extent of audit procedures. The nature and timing of audit procedures again would include at what point in time you will do an interim review, at what point in time you will send out confirmations, at what point in time you will carry out a physical verifications or testing of any of the variables, whether it is an impairment, if it is the companies complied with the IND AS or the IND AS is applicable to such companies, what are the important things that needs to be done. So those are very, very essential aspects of it, apart from the reporting requirements that's required under the fraud regulator. The robust documentations and obtaining sufficient appropriate audit evidence. Again, let me tell you the experiences that we are seeing over a period in time in terms of various regulators who are coming through and questioning the very basis of what we have carried out an audit. So therefore, if what the client provides us information and what is provided to us and what we carry out, and there is no corroborative or what is called as other than the information that is provided, called the contrary evidence, I think it becomes very, very important for an auditor to just be mindful because regulators are coming through that anyway, the client provides you information, you have tested the vouchers provided by the company, what value add have you brought in? What is the contrary evidence that you've brought in? So therefore, I'm moving away from obtaining sufficient appropriate audit evidence, which is normally that we learn in our auditing standards, to a concept called obtaining contrary evidence. That is, what could go wrong? How do you do it? For when you say contrary evidence, is let's say you take a case of NPA classification, and you know that in NPA classification, the company, the entity which is being for which the loans have been given sanctioned, has been servicing the loan, and therefore it is a standard asset that does not impact. Whereas you have a knowledge about that company is in losses. It is only managing the NBFC in terms of paying the terms of interest and principals, whereas the company is actually working on a borrowed funds with huge losses. And there is every likelihood in the next couple of years that the company will not be in a position to service. So therefore, if you have that market information, whether it's from an MCA website or from any of the releases that they would have got elsewhere, let's say a same company which has got borrowed funds from other banks, and that's where the report is got, this evidence becomes important. So therefore, it is important for all of us to understand the contrary evidence is much more given weightage than the evidences that we obtain through what is the information that is provided with the company. So very important aspect of it that we need to understand that audit no longer is that what is given to us, what is verified, what is submitted. No, audit means it's beyond the book. So therefore, please focus on those aspects of it. With the classification by the NBFC in terms of the base layer using a threshold of an assets of 2,000 crores to a middle layer of greater than 1,000 crores and an upper layer which is classified by the significant amounts by the RBI because based on the asset base, it's important for us to understand the systemically related, non-accepting deposits or deposits and the classifications. There are circulars that are issued in terms of the NPA provisioning norms effective October 2022, which will have implications for some of the base layer companies in terms of applicability from a 180 days to a 90 days. So and there is the period of transition that has been provided in 24, what would you do? In 25, what would you do? In 26, what you do? But it's important for us to understand that under which layer does you are auditing. Does it fall under the less than 1,000 crores? Does it fall under the greater than 1,000 crores? Does it fall under the upper layer? So therefore, it is important for each one of us to understand and look at the classification because every classification is compliances. If you look at the upper layer compliance or middle layer compliance, I've got higher compliances than the base layer. So therefore, when you look at application of these norms, prudential norms, it becomes much more critical. So therefore, please make sure that the classification in which you're carrying out an audit, does it fall under the base layer, middle layer, and the upper layer? Just to get you an understanding of what is the base layer for an NBFC, basically, it's nothing but the existing non-depositing, non-systemically important NBFC called the NBFC NDs, whose asset size is about 500 crores, but less than 1,000 crores, and will be a part of the peer-to-peer lending platform, or could be an aggregator, or could be in non-operating financial holding companies where there is no public funds or a customer interface. Important for all to understand that while these are the base layers, so therefore the applicabilities will not be so much as you find in a middle layer. In respect of the middle layer classification equivalent to existing deposit-taking NBFCs, again, include standalone primary dealers, infrastructure debt funds. Again, it is important that the understanding is the applicability of higher regulatory supervision, and that is where it becomes very, very important. Again, this is very critical because this is where the regulatory arbitrage would come into play between the banks and the NBFC. And this is where it is. Then comes your upper layer, again, the most eligible NBFCs in terms of the asset size factors into the upper layer, higher prudential norms, intensive supervisions, all would be applicable for such criteria. Both quantitative and qualitative would be reviewed. There would be regular inspections and the reports will become. What's important for all of us? Whenever we carry out an audit of an NBFC, always look at if there are inspections carried out by any regulators, because that should form a part of apart from your audit planning process that you will have. It becomes a very important aspect of it to understand the quality of the asset, understand the quality of the supervision or the governance of those assets, understand in terms of whether there is an issue of relating to certain assets for which provision would otherwise wouldn't have been done. So look at from that perspective, look at if there are any fraud related matters to be looked at. This is just a classification which you would be aware as an asset finance company is dealing in financing of physical assets. Investment is predominantly acquisition of securities. Loan companies, again, is providing business loans. Infrastructure companies where you have 75% of the assets are in infrastructure loans and a net owned funds is greater than 300 crores. Mutual benefit, miscellaneous non-banking and savings restricted non-banks. These are some of the classification that you have. Again, classified between non-public and public, between systemically and non-systemically important NBFCs, and all of that get covered. Now, the great change which has come through in the appointment of auditors. And this is very, very important, whether it's the appointment of central statutory auditors, which is the SCA, or the statutory, which is SA, where the terms would be used in my next slides. Important that we need to be clear as to if we have got a restrictions in terms of the number of audits that we can carry on. And therefore, before accepting any NBFC audits, just make sure that you're within that threshold. There are requirements in terms of the eligibilities. There are requirements in terms of partners' experience. There are terms in terms of having knowledge in relation to the computer-aided techniques, audit techniques, and all of these are important. Please make sure that when you're applying for any of the bank audits, NBFC audits, these are the things that are considered as part of this. These are applicable to all the NBFCs, and especially non-deposit as assets greater than have the option to continue with the earlier procedures. But it's important that there has been some element of flexibility, but now it's more than 1 year. Now, many of the banks, NBFCs have moved away from there. Whilst prior approval of RBI is not required, but it is important that the NBFC informs to RBI about the appointment of the central statutory auditors or SAs by way of certificate within 1 month or within 4 weeks of that. Again, there are classifications in terms of the size that one has to look at it in terms of it. If you look at the minimum number of audit firms to be appointed based upon the asset size, again, if it is below, you can have 1, greater, you have a minimum of 2. Then the maximum also is be given based on the asset side. If it's more than 5 lakh crores, more than 20 lakh crores. So it goes at 4, 6, 8, and 12. So between greater than 5, but less than, this one is about 4, about 10 crores is about 6, 10 to 20 is about 8, and is about 12. So therefore, it's basically, there is this restrictions of the number of these. And I think it's a very important aspect of it, because if you restrict the number of, also you will also have people who are focused or who make sure that only these number of audits, and they'll have it, even because especially when you have a joint arrangements, you cannot have 130. Take case of a bank, you will have more than 130, 150 chartered accounting firms who are appointed. I think it's very difficult to manage this. Whilst you might say that from a branch level, from this, you would still do it, branch, regional, zonal, and central, you do it. But I think it's important that the focus, especially on NBFC, is not larger than size, but still it is important that if it's spread across, and this would be on the upper layer, it's much more that it is focused. Moving ahead in terms of the eligibility criteria, again, as I said, asset size up above 15,000 crores, we are talking about the audit firm should have at least minimum of 5 partners who have put in 3 years of service. Of the total, this one, the partners associated should be associated with the firm. Minimum full-time partners paid CS should be 2. Then the minimum expense is 15, and minimum is about 18. So this is basically just trying to bring in terms of the structure of the people that you have. Again, you need to be mindful in the terms of number of audits that you accept, and you should see the size. It should be this is a minimum that's been prescribed, so multiplied by the number is what you should have when you're accepting any of the NBFCs. What are the other additional considerations that you need to look at? You should have a fair knowledge of the functioning of whether it's an audit of the Union Cooperative Bank or branch, or you should make sure that the code of ethics is complied with. You're complying with the Section 141 of the Companies Act in terms of if any of the non-audit services. Make sure that the firm is not debarred by any of the agencies, and also shall not be, if you are a director of a public sector bank, and that should not, if any of the chartered accountant is a director of the public sector bank, and particularly that entity, you cannot appoint any of the as statutory auditors. Make sure that if it's an asset side is greater than this, and you have people who have got knowledge of computers, and you use a software to make sure you understand the applications of it. Again, in terms of these applications, whether banks use till the completion of 3 years, make sure that whoever is appointed obtain the certificate, and such certificate, once they are appointed, should be submitted to the Reserve Bank of India. The names goes from RBIs in terms of their appointment. Can a concurrent auditor be appointed as this thing? Answer is no. There is this period that is looked at in terms of cooling period. So therefore, you cannot have a concurrent auditor being appointed as the statutory auditor. There is a gap which is in respect of the non-audit services. It's minimum of a year before you can accept any of these things. Now, if you look at the concurrent auditors, you can have for a period of 3 years, and the entities will have can appoint it, and therefore, even if they are once they go out of the cooling period, they can make sure that they get appointed. So, but it's important that during the period of concurrent audit, you cannot be appointed as the what is called as the statutory auditor of the company. So, therefore, just make sure that doing internal audit or concurrent audit, you don't fall under the ineligibility norms of this one. So let's focus on this, the main aspects of in terms of how do we audit and what is the scope and objective of financial statements. Again, the scope is determined under the Companies Act. The scope is determined under the Schedule 3, which is the under the accounting standards. And also there are specific norms which are required, specifically required to report under the NBFC. So there are additional requirements. So there is a base form that is used, there is an accounting standards that are used, and there are certain disclosures which the RBI would require as a part of it, apart from the normal reporting on CARO and all of that, which is required under the normal Companies Act. Again, it's important that you identify whenever you're carrying out the audit of an NBFC, you have to identify under which financial framework, reporting framework that you're auditing it. And therefore, you need to bring that framework, and those frameworks should conform to the changes that have been brought in. Whatever schedule the changes that have been brought in with the Division 3, you make sure that those things gets applicable. Make sure it's important for all of us to understand that before we we start the commence our audit of NBFC, we need to agree to the terms of the engagement, make sure what's your role, what's the role of the company, what's your responsibility, what are the skills that are required, what are the expertise that you have in the businesses that you're doing, you have an understanding of that, and the complexity of the IT system that the entity in which you're going to audit. Why it is very important is the more it is complex, maybe we need to use a computer audit specialist to run this whole session. So important for us as a firm to make sure have a complete download of understanding of the entity, its operations, its systems, its structure, all of this, and get the engagement letter signed part of it. Why this is important is because every structure also has got an important aspect of relating to the control systems. And if it is spread across central to branches to various geography, and how does the structure work becomes very, very important. So make sure that you have an understanding of the risk management controls or the procedures that are followed, or the risk control matrix which the company has prepared. Look at the internal control documentation. Look at how robust is the internal audit system, because the higher the high level of the internal audit system, both by the internal or by the external, that is what will determine the nature, extent, and the timing of the audit procedures that we would carry out to conduct an effective and an efficient audit. And it's a very important aspect of it. And why this is important is higher the controls, higher will be the reliability on the processes, and higher the intervention of human, the higher the risk of material misstatements due to fraud and error. This is very, very important. Also, when you do, even it doesn't mean that when you carry out an audit, and if it is at a high level of very highly complex integrated IT system, does it mean that there won't be fraud? The answer is no, there will be. You need to understand the complexity. There could be certain times, are there any downtime of any of this IT system? Has there been any breakdown of any system? Are there been any compromises where there has been a cyber risk or a cyber attack which has come up on these systems? That is what becomes much more important for you when you do an assessment of an understanding of the IT system. And you should also see, very, very important, are there any systems that works and people, and especially during this COVID period when many of the people operated through a virtual private network, where any of the systems got compromised, what are the controls that was exercised, how do you ensure the data integrity? These the risk which comes through it, because this becomes inherent risk. This becomes, see, one is a risk of, a person can commit a fraud, a risk can think something can go wrong, you give lend to a borrower and when. But what is also important is how do you evaluate such system? How do you evaluate a borrower? How do you make sure that the business is run on a continuity basis? So these becomes very, very important. Higher the controls, higher the oversight by the governance, the better is when you are assessing. So therefore, when you carry out an audit plan, it should be well designed with an understanding and the knowledge of the entity, and the understanding of the structure of the governance, understanding of the IT systems, understanding of the risk management matrices or controls that are in place, understanding how the controls are operating, whether effectively or not, understanding whether they have internal audit system. All of these becomes very, very important aspect of it. Apart from this, if there are reports that comes through, there are the inspections that happens, seek understanding of that and make sure when you do an audit plan, it considers all of these aspects of it. The fundamental principles of an auditor is the issue of a going concern. I think this is a very important aspect which is not understood by all of us. I mean, let me be very honest with you on this aspect. See, unfortunately, when we talk about a going concern, our standard on SA 570R talks only of a going concern to the next 1 year assessment. Whereas, where I give you an example where a particular borrower was paying the interest and principals, but when you look at the contrary evidence that his financial statements are only surviving on him, and you will know the next 3 to 5 years, that entity will collapse. And therefore, your asset becomes an asset which gets stressed, and therefore you may need a provision. So is the case of a going concern. You are not only supposed to look at for 1 year. Like, for instance, if you have to test an impairment of an asset or a goodwill or an intangible, you have to look at for a minimum period of about 5 years. So our going concern, while the standard says SA 570 talks about a next within 1 year, I think our going concern assumption should be extended beyond that period. Even though the norm talks of 1 year, my ask to each one of us as a part of an auditor, look beyond 1 year. And this is a very important aspect of it, because businesses do well today, collapses tomorrow. When it collapses today, tomorrow, the first question comes back to the auditor. Did the auditor close his eyes, not seeing that the business will collapse tomorrow? You may come back, you may not agree to this aspect of it, but that's the ground reality. That's how the users of the financial statement, that's how the stakeholders of the financial statement are looking at us these days. Determine the nature, timing, and extent of audit procedures to be performed. Very important aspect of it. What point in time you will carry? Do you tell the team that you will carry out a physical verification of cash on 31st of March, or you'll carry out? You may do a physical visit without even informing, you might carry out. So therefore, bring the element of surprises in an audit. Do not, apart from your interim nature, timing, and extent, include in the nature, timing, and extent those surprises, checks, and balances. You might have visited to carry out, let's say, physical verification of assets. Suddenly, you can go and make sure to visit some of the borrowers, or you might go to the particular branch and verify whether the investments are intact, or you may carry out this, or you might test certain internal controls. Look at for all of that. Bring the corroborativeness, or bring that element of surprise audit when you do your nature, timing, and I think do not follow a pattern. Follow a surprises audit when you do any statutory audit, and that is the expectation of this. Coming back on the obtaining the knowledge, it's important that we need to understand the governance structure, economic regulatory. Again, look at this economically. If you have funds, if you've got swaps, if you've got certain things, currencies, there is a lot of this volatility. Or if you've got transactions of that with that entity which is actually borrowed from you, has got export or import, they could have a lot of impacts. While at the time of assessment of providing them a loan, you would have felt that they are doing very well. But the conditions of the market, the economic or the regulatory, or you could have a sanction, whether by the Europe or the US or anybody else because of a war, it could have an impact. So have an understanding of this. Remember one thing, whenever you look at financial market, get the market research report before you start any audit. And that discussion should have seen that impact on the NBFC that you're having. It could be leasing, it could be loans, it could be anybody else. Products and services, service organization, the risk becomes very, very important when you deal with that. Again, coming back to this issue of fraud, again, why am I emphasizing on this? When any NBFC deals, it deals with money, and money has the element of fraud. Other than it could have a fraud, I could do what is called a fraud to physical dealing of cash. I can do a fraud by misstating or fraudulently reporting of financial statements. So it could have a combination all of this. It could have a structured combination also, saying that you're funding an asset which doesn't exist. And therefore, it becomes very, very important. A falsification of ORM can result in a misstatement that's also equal to a fraud. So therefore, bring this element of professional skepticism when you carry out an audit. Again, a professional skepticism is what is written in an auditing standard is fine, but it's important for us to discuss with the team. Say, what can go wrong? What is that something when you deliberate among this? Again, this is important when I do with the students, when I do with members. One thing which I potentially ask, do you take a decision as a partner, as individual, or do you take a decision collectively? Do you sit when suppose some of your assistant or an associate or a qualified comes back and, sir, this company seems to be a problem, there seems to be an NPA, there is something. Do you look at from a banker's perspective, from an NBFC perspective, say that, hey, listen, if you report, he may lose job. If you report, he may lose job. But if you don't report, you may lose your certificate of practice itself. So today, the scalability of such issues have gone up, and therefore it is important for all of us to understand that information, whenever it comes to us, in terms of any risk of material misstatement due to errors or fraud, or misreporting of information so that the NPAs are appropriate, that becomes an issue where you need to discuss with the team and make sure that such information is critically analyzed and come to an appropriate conclusion, whether it is due to fraud or not. Because any fraud, right, there is a lakh of a rupee, there is a crore of a rupee, but any fraud of a magnitude has to be reported within 3 weeks. So therefore, look at from that perspective of your reporting responsibility. 1 lakh fraud is okay, but 1 crore fraud, you have got reporting to both companies. Under the Companies Act, you would go to the Department, Ministry of Corporate Affairs, or you might go to the RBI because in NBFC. But it's important that look at those classification from a concept of professional skepticism, from a concept of whether it is due to fraud or error. This assessment of the audit evidence should not be taken individually by the partner, but by the team collectively assessing all this information which is available to them. Again, the classification of fraud, which is more than lakh and above, frauds committed by the unscrupulous borrowers, or fraud involving more than 1 crore. So there's a classification that is there. Again, there is within 15 days, if there are normal frauds which are reported, end of the quarter, you have to provide that information in the report called FMR. Within 3 weeks, if there are any actual or suspected frauds, again, it should go to the regional offices and make sure all of these informations are captured and provided to the Central Office of the Reserve Bank of India under the supervision of Frauds Monitoring Cell. Again, what is important for all of us, we need to understand that information relating to fraud, any amount is a fraud is a fraud. The intent to this is, so therefore he says, sir, pehli baar galti ho gayi, sir, maaf kar dena, hum log unintentionally we never knew it. The question is, there is nothing called a fraud remains a fraud, whichever it is. But there is a reporting requirement that's required under this. Please look at it. If there are changes to the form, please make sure those are updated on regular basis. Now, there are also a requirement by the NBFC. So therefore, whenever such fraud happens, right, just make an inquiry with those charged with governance. It's a very important aspect of it. Talk to the board of directors, talk to the audit committee members, talk to them. Have they come across if there are any frauds? Have they looked at any of these issues which they come? Has there been any reporting which has been given? I think time has gone where we should look at audit more from an investigative mindset than just by a compliance mindset. I think time has come that, the stress that is which is going through, let's say there is a CBI raid, the auditors gets picked up. There's an infra issue comes, the auditors gets picked up. What happens to the companies? What happens to the officials? What happens to them? Nothing. So why we taking that risk and responsibility onto one, thinking that client is mine, client is ours, they are paying us, so we should do it. No. You have a legal obligations. And when we have a legal you and I, when I say you and I, me, everybody has a legal obligation to make sure that today's expectations is beyond audit. Today's expectation is reporting on fraud, and that's what becomes very, very important. Remember, the larger the size of the joint audit team, the more collaborative or more cohesive approach one should approach. It is not saying that he's a big auditor, he's a small auditor. Every auditor is an auditor because both of you sign the same balance sheet. So look at the responsibilities under the SA 299, responsibility of joint audit. And make sure that whenever you have such clear-cut understanding of what is expected of you, clear-cut understanding what is expected of the joint auditor, have regular meetings with the joint auditor, make sure that you have complete understanding of the areas that are done both ways. It is not that your area versus my area. If you find across that any of the areas you require additional information or additional procedures to be carried out, make sure that a similar process is done. You cannot say that I've done one area, so therefore I will only sign one area. No, collectively we are signing the entire financial statements, and therefore becomes important. Also have tough discussions with those charged with governance. And I think it's important. Bring them onto the board to have an understanding as to what they believe fraud is. Because it's not you alone. Because whenever you come back, go back and share a report of a finding. What is that they've acted upon? What is the action that they have taken? How do they reflect it? Take, for instance, there is this internal audit which goes in-house internal audit, and they go on saying that this is not their NPS to be provided, and checks not received. And the management representation is no, this is a very good customer. He has promised, he has given this check, he has got his personal issue. There is a problem in his family, and otherwise this amount would have been paid. And the board is right, very, very happy. I think whatever you say is fine. But I think what you need to start looking at it beyond. If a person has not paid because of this, it's not because there's a personal condition in his family. Because of the financial health of that entity is why he has not made a payment. So I think that is what we need to look at it, other than getting into personal or an emotional aspect. Unfortunately, whenever it happens, whenever we want to report, the first thing which comes about is the personal aspect or the emotional content. So let's get away from there. There is no one to support you other than yourself. What are the things we need to look at it very, very closely? CARO 22, Audit of Financial 143, Audit of Internal Controls of Financial Reporting becomes very, very important. Special report to Board of Directors, limited reviews, certificates. As I said, there is a host of things. When you sit for an audit plan of an NBFC audit, look at the applicability, have a discussions of the changes. And the way you keep discussing changes is what will help you to make sure it is done. Again, there are some additional requirements to be reported for the NBFCs which undertakes public deposits. Make sure they are within the limit. If they're beyond the limit, you have got a reporting aspect of it. If there are the capital to risk weighted average asset ratio is lower than 15%, make sure that whether they've been done with the rating agency. All of these becomes very, very important respect of. the 45(1)(b) of the Act. So there are various things which you need to look at it and report it. I'm not getting into specific details, but I'm just leaving a thought with you saying that, listen, make sure if it is classified within public deposits, deposits taken, non-deposit taken, applicability of deposits taken is different. Same as the reporting requirement under the Companies Act, which you have to give the list of companies within 3 months. All of this becomes very, very important aspect of it. These are some of the things which you need to report. If it's a certificates that are issued, make sure that you comply in totality related to the guidance note issued, and make sure that you provide for all of the procedures that are required under the guidance note issued by the ICI. Remember, RBS notification guidances, which is regularly done, you should make sure that these are all comply to it on a day-to-day basis or on a regular basis. Laws and regulations, these are some of the things: Reserve Bank of India Act, NBFCs, Master Circulars, Notification Directions, Companies Act, Income Tax Act, Technical Guide on NBFC, Standards on Auditing and Accounting Standards. Again, these are classified between those where Ind AS is applicable, where Ind AS is not applicable, and the classification goes upon. So let's look at some of the non-performing assets. And as you're aware, NBFCs or any other banking has got a classification that you need to do in terms about how strong are the assets, whether it's getting serviced, classifying between standard, substandard assets, doubtful assets, and loss assets. And the provisioning norms should again be up to date as per this thing, the latest one. There is this expectation of harmonization of NPAs for all layers of the companies, which will be applicable to the base layer also. Make sure these guidelines, which are issued as of October 2022, are looked at it in detail. There are different provisioning norms that have been provided. Look at all of these circulars. Again, I'm not getting into more detail specific. I'm only guiding you where you need to look at in terms of what circulars you need to look at, applicable both for the middle and the upper layers. So there are certain things which are applicable for 31st March 2023. Look at those classification of assets, look at the provisioning threshold, make sure that, when these information, especially this is called the scale-based regulation called the SBRs that are required. That's why I said you need to be very, very careful in relating to this. So all circulars which are effective for guidelines, which are effective from 1st of October 2022, make sure these are all complied with it. Again, this non-banking the non-acceptance of deposits of less than 1,500 crores, which has an overdue of 90 days. Now, certain things have moved to 90 days. Now, for such companies which are NBFC NDs, which less than 500 crores, there is this harmonization that is coming through. And that's where they're planning to, over a period of time, gets into an NPA disclosure by 2026. Again, harmonization is nothing but having different reporting is not going to change. So they're bringing everything under the 90 days. So non-systemically important, non-depositing NBFCs, everybody has to comply to this base year. But there is a timeline that has been provided from 180 days that you had to 150 days by 24, 120 days to 25, and 90 days to 26. Again, the classification of prudential norms on income recognition and asset classification and provisioning for the IRACP. There are circulars that are issued in terms of classification. When can you upgrade an account which was classified as an NPA? It's only when you receive the entire interest overdues and the entire payment of principals. There is this circular dated which is given time to 30th September 2022. If you're carrying out any of such audit, make sure you look at all of these as a part of it. Again, if there are special mention accounts classification requirement, which is under stressed assets, look at it from that perspective. Make sure there's references as to how these NPA norms are applicable. The special mention accounts needs to be looked at much more closely when you look at. So as I said, these are some of the circulars which you need to be very, very cognizant. Again, these are only the tip of the iceberg. There could be many more that you need to look at it, but look at from a perspective of compliance that there are changes coming in terms of the provisioning for NPAs. There are specific provisionings that are coming through for the special mention accounts. The scale-based regulations have undergone change. So look at all of these, very, very important. Now, one of the aspects of that which has come through in respect of the Companies Act, in respect of frauds that is happening, predominantly happens through related party transaction. If you really look at it, related party transactions in the past, in fact, when I started or when we were there as an auditor, related party transaction is, it used to give a Companies Act, used to give a list of various about 13 to 14 and saying that this is mother, father, brother, sister, sister's wife, brother. All of this used to be, and if they are not covered under it, becomes a related party. Now, related party transactions is not what is defined under the classification of in relationship. Please understand this. Related party transactions are those transactions between two parties where a person is in a better position to influence or has got a significant influence on transactions, and that transactions becomes distinct. For instance, this company which is formed A and this company is B. The directors of these companies are not the directors of these companies. The employees of the companies are not the employees of these companies. But all of the decisions of this company is taken by somebody who is related to this company. There is significant transaction which gets rooted in the company B, and the company B gets undue benefit of it. Then that company will form part of a related party transaction. And why I'm saying this is very important. The structuring of transaction which has happened, and many of these frauds that has come through, is predominantly through the structuring of transaction, which whilst you might say they are not related, but the nature of the transaction, the manner in which all of the transaction which happens is not in the normal ordinary course of business and not in the ordinary course of the contracts that you would have entered. And therefore it is important for us to understand that the related party transactions is beyond a contractual term that is entered. It is where you need to lift the layer beyond or lift the wheel beyond to see whether there are such transactions. And I can share with from my practical experiences, janitorial services, which normally people don't look at it, or a transaction relating to a freight or a commission, where people think it's an ordinary thing because they'll say 2%, actually found out that these people, while the main people are not there, but the employee relatives were running through those processes and they were considered as related parties. And this becomes a significant scope for fraud because all of these payments goes through this. So therefore, be careful on people, be careful on the contracts, and even, for instance, you may have a consultant who would be playing a particular role. So therefore, be mindful in terms of when it comes to reporting. The definition of related party transactions under the Companies Act 2013 to Ind AS 24 to AS 18 under the accounting standards to the listing regulations. Just look at all of these. It talks about, even for if I were to take on 2013, and if I look at specifically apart from the what is called as a percentage of 2% or manager, look at it, anybody corporate whose board of directors, managing director or managers accustomed to act in accordance with the advice and directions or instructions of a director or manager. That means the person, he has to have the final say, right? He will have that person. Or if you see Ind AS 24, a person or a close member of the person relating to the person has a control joint, has significant influence over the reporting entity. So when you have a significant influence over the reporting entity, it becomes very important. It doesn't define a relationship. And if you look at the AS 18, individuals owning directly or indirectly or an interest in the voting power of the reporting that gives them control or significance over the enterprise and relatives of such entity. And there is a listing agreement which talks about any person holding beneficial interest will have to have more than 20% or 10%. Therefore, related party transactions now is beyond the definition of a threshold. You have to look at it much, much very closely. Again, I said, you have to be very careful in terms of who is controlling it, who is jointly controlling it, who has got significant influence, what is the responsibility into it. So all of these becomes very, very important. And you need to provide complete disclosure relating to it. You need to provide the prices at which it is charged. You need to look at specifically more closely in terms of what is required in relation to such transactions and such disclosure. So please make sure that if you're falling under listed companies, this CBS come up with a requirement effective 1st of April 2023. Ind AS 24 has got different, and AF's Companies Act got different. So therefore, these are some of the things which you need to start looking at it. There is this process of approval between the board, audit committee, if it is arm's length, not arm's length, what has to be done. I think never have been in the history where you have come across where we have said that the board has done a fantastic job of identifying related parties. I think if the board did what they were supposed to do it, I'm not saying that all boards are not doing it, but today's board requires more rigorous understanding of related party transactions. They should question every transaction as much as they question every auditor is questioned. You need to look at it much more deeply. Again, for listing requirement, all RPTs and subsequent modifications should be reported. All transactions should have the approval of the prior audit committee approvals. Where it is not listed, it is not required. So these are certain things which are important. If the transaction is within a period, then it can go through this. So there are various requirement of reporting. This is more from a compliance perspective, not from an assessment perspective. Assessment still rides with the auditors and the assessment of that. Again, my discussions with you and my suggestion, recommendation with you is to make sure that you have a discussion with the company secretarial team, you have a discussion about the various transactions, and especially focus on transactions which have actually been entered. And you look at least, sending confirmation is one aspect of it. My recommendation is do more of analytics. Look at which are the parties who have been added this year. Look at which are the parties whose contracts are different from the last year. Look at those things where there is significant shift in terms of the monies being given or lent. You will get what is called a trend that you can do. Do a trend analysis both at an expense level, payable level, asset level, and liability level, or income level or expense level. You will know that there could be uniqueness that you could find out, and such assessment can be looked at from related party transaction. Again, when you look at capital requirements, the tier 1 requires a tier 1 capital minimum of 10, and then the overall between tier 1 and tier 2 is about 15%. They need to maintain the CRAR. So therefore, from a risk capital to risk asset weighted ratios, you need to risk weighted ratios to make sure that is done. Compliance, again, as I said, there is a method that has been provided in terms of the ratios. If you're dealing with gold, it's about gold jewelry, it's about 12% of the capital that you need to have minimum. If it is tier 1 and 2, it should be minimum of 15% of aggregate risk-weighted assets on balance and the risk adjusted off balance sheet. Again, these are all information that you need to look at it from a calculation perspective. I'm not getting into more detail related to it, but just leaving a thought to it that whenever you look at it, it is not only what is available on the balance sheet. Look at those which are off balance sheet items. And that would determine the exposure the company is looking at it in terms of what is the commitment that's given it. Balance sheet, anybody can do it. Off balance sheet is where the risk is very, very important that we need to look at it. This is just the calculations which I'm not getting with it, but just for an understanding of a ratio is the common equity by the total risk weight assets, and it gives about all of these. The disclosures and financial statements to NBFCs required prudential norms, applicable accounting standards, is in compliance with the scale-based regulations, the SBR framework that needs to look at it. More comprehensive disclosures are required for an understanding of the financial position and performances applicable to all NBFCs. Just make sure that these guidelines are followed in totality. There are formats that are given for NBFCs between the current year, previous years, the comparatives that needs to be provided. There are information that is relevant for you have to explain, make sure it is explained. Let's look at some of the exposure. And as I said, without having an understanding of the real exposure of sector-wise, it's very, very difficult for anyone to carry out an audit. And especially these are applicable for audit of financial statement of base layer, medium layer, and the upper layers, middle layers and the upper layers, and make sure your understanding of the exposure relating to residential mortgages, commercial interest rates, investments, again, exposure to capital markets, IPOs, ESOPs. Now look at some markets, something happens in the country, the impact it goes significantly, and sometimes you find that you are doing well, but suddenly the exposure goes up. Look at all of these more closely. That means for which you need to have a complete understanding of the secretarial, complete understanding of the approvals that have been received in the board. Make sure all of these are done comprehensively. Important for us to understand that whilst you could have a lot of saying yes, no, no, make sure the company prepares this information and shares it with you. Make sure you carry out procedures to look at it much, much closely. Again, sectoral wise, if you've got agricultural, you've got services, about the exposure on the balance sheet, off balance sheet, gross NPAs, percentage of gross NPAs, total exposures, and all of this becomes very, very important, including the personal loans. And you should also look at if there are any intra-group exposures which are there, and especially if there are top 20 intra-group exposures. Make sure what is the exposure between the borrowers and the customers, the unhedged foreign currency exposures. All of these should be captured. Related party, I've talked a lot, but this is again, you would have seen over a period of time, but these are the information that needs to be captured on a regular basis. And especially if there are any item which is more than 5%, provide that information directly into this because they would have a significant influence. Now, the other aspect of it, which we should look at it, if there are any complaints received from customers or from the offices of ombudsman, basically this is nothing but to identify if there are any fraud-related aspect of it. Please do not take this as a normal information. Look at it from a perspective of saying that how are these complaints, nature of this complaint, the cause of this complaint, the source of this complaint, and how such complaints got addressed. And I think maintaining such information is very, very important, and without which it's very difficult for us to prove in any court of law. So this is very, very important. The top grounds on which you have received, what is the time which is received, what is the period, how it's outstanding for more than 30 days, all of these needs to look at it. Information relating to the LODRs, this composition of board of directors. Again, you look at it in terms of what is the age, period, number of meetings, what is the amount is being paid, what is sitting fee, commissions, and all of these. Changes in the commissioner, in the composition. Again, these are from a corporate governance perspective and not getting to it, but just make sure these are all complied with it. If there are any non-compliance to Companies Act, you need to give. If there are any penalties and strictures, you need to provide. This is a very important aspect relating to NBFCs on gross NPAs. Make sure, again, I'm telling you, make sure whatever you report as NPAs in the financial statements, if the RBI has carried out a report or analysis, or if there is inspection carried out, the NPAs provided by in the financial statement should more or less be the same which is reported or higher than what is reported by the RBI. Otherwise, in the event of any challenges, you run into a problem because they will question that how did we have an NPA which is different from the NPA. This is a very important aspect of it. NPA, whatever the NPA that we provide, make sure that it is in line and the reconciliation is carried out. If we don't do it, it's a problem that will be come back to the audit and audit firm, auditor and the audit firm. So make sure these are all taken care of it. The Schedule 3 of the Companies Act, which talks about complying with the Ind AS of the Division 3, make sure that, again, these are applicable for where you need to comply with Ind AS. Apart from the information you need to provide for changes in equity, statement of equity, cash flows, and all of that. Information which will provide a lot of these Ind AS information requires to be included, which includes balance sheet changes in equity and all of that. So these are additional information that has been talked about, whilst the Ind AS talks about information to be provided basis on the permanence, whereas your Division 3 of Schedule 3 will talk about in relation to the liquidity. So there are differences that are required, but what is important is material items. Again, material or materiality is in relation to the uses of financial statements. So therefore, do not go by percentage, but how reflective it is. A fraud item, even if it is a lack of a rupee or 50,000 rupees in overall context of 15,000 crores, is a material item. So material item is different from materiality. Materiality is basically based using a benchmark to see if there are material is from a perspective of qualitative aspect of it, which could have a significant influence on this. So therefore, if there are any such information related to it or any expenditure more than 1% of the total income, provide information. And again, these are all required under the Act. Materiality again should be, it's basically a combination of information which is available as well as information which is based on judgment. So look at all of these. Disclosures required under Ind AS, you need to look at the classification of the fair value hierarchy. Basically, the using fair valuation hierarchy 1, 2, and 3. Looking at capital management, disclosure of interest in other entities, all required to be doing, because sensitivity analysis to be provided under the disclosures. There are various information that needs to be included under the Division 3 to Schedule 3. So therefore, make sure that the definitions, everything gets captured over and above what is required under that. What are the areas that gets impacted if your entity in which you're auditing is an NBFC? Make sure that the fair valuation of ESOP, segment reporting, derecognition of financial assets, securitization, business model assessment, classification of debt and equity. Again, if it is an Ind AS 109, and a typical example could be between an equity and a convertible preference capital. In fact, if you look at preference share capital or partially preference share capital, whether it's in the nature of equity or a debt, you need to classify that that portion of classification. So therefore, preference, unlike in a non-Ind AS regime, will go and sit as a part of share capital of equity, whereas under the Ind AS 109, it will go under the classification as a debt or an equity. So make sure share warrants can go into the nature of an equity and a debt. Any convertible features can go it, a put option can go to it. So look at all of these aspects of it when you deal with it. Presentation and disclosures, expected credit loss, again, from an Ind AS perspective is different from an NPA provisioning. Is again, NPA expected credit loss is determined based upon the quality of the assets which you expect that a particular borrower will tend to fail because of the credit risk which is associated or the time value of money that will be associated. So therefore, make sure the expected loss, effective interest rate is different from the interest rate that is given on the, which is sanctioned. So therefore, these are some of the things which you need to be very, very mindful when you're dealing with the ESOPs classifications, segment reporting. So if you are doing Ind AS, make sure you have all of these. What are the other points that you need to look at it from a perspective of NBFC accepting deposits, holding deposits, co-investment companies? Again, co-investment companies are those companies which have got investments in the companies and a particular threshold of revenue to be obtained. So these are some things which you need to have. Again, as I said, the regulatory requirements may vary depending upon various levels. There are certain exemptions relating to housing finance companies. NBFC will be covered. Will not cover the housing companies. There are certain things which are under SEBI. There are certain microfinance companies which are excluded. So there are various insurance brokers are excluded. So there are merchant banking companies, mutual benefit companies, microfinance companies. All of these are exempted and they will not fall under the applicability of Chapter 11(3)(b) of the RBI Act. Government companies, venture capitals, nidhis, mortgage, and all of this. But when you look at exemptions to the core investment company, the CIC, core investment companies, an asset size of more than 100 crores is called systemically important CIC or CICND. It should satisfy 90% of your assets should in the form of investments in loans, group companies, and investment is income from such should not be less than 60%. It does not trade in investment in shares and all of this. So there is this. You need to obtain a certificate of registration under 45IA of the RBI Act, and the registration shall be applicable within a period of 3 months from becoming this. So therefore, make sure that the company applies for this registration. Otherwise, non-registering with the RBI will cause into non-compliance or violating the CICAC norms. There is this adequacy norms for CIC, which talks about at least a 30% of aggregated weighted average assets. It talks about Liabilities cannot exceed 2.5 times of the adjusted net worth, because we are talking about more about closely with the group companies and all of this. So make sure there is this annual auditor certificate that is taken in respect of the CISC complying with the prudential norms. Now, what are this annual certificate that should comply with it, and what information gets captured, whether having a financial asset more than 50%, excess of income of 50%, asset finance company of greater than 60%. So there are various things that you need to look at it, whether it's infrastructure loans, 75% and 60%. So there are certain things which you have to go through it. Look at it much more closely from that perspective. Make sure that all of these information that you're capturing as a statutory certificate, have an engagement letter, carry out audit procedures, do a similar audit procedures, get a representation letter, and then issue a certificate. And I think this is a very important aspect of it, and comply to the guidelines which are issued by the ICI. And this is very, very important aspect. This is the classification of CR, AR between the total capital assets, and especially which includes Tier capital of 15%. So therefore, it includes Tier 1 and Tier 2. Again, this is a risk-based assessment that you need to look at it. Look at the weights, because cash and bank does not carry any weight. Bonds about 20%, fixed deposits 100, and all of these. These are some things which you need to look at from that perspective. Off-balance sheet items, as I said, you need to be very, very careful. Look at from a financial and other guarantee purposes, partly paid up shares, bill discounted. There are various securitization of standard assets, non-fund based, and all of these becomes the same. So make sure that the conversions are very, very important. The undrawn portion becomes what becomes your undrawn commitment. So when you're calculating the off-balance sheet items, make sure your appropriate information is captured, and that becomes the exposure, which will be, because what you've already lent will already be covered as part of this. What is not lent becomes part of the exposure. So to just give you an example, if you have got 150 crores and 50 crores is drawn down, therefore 100 crores becomes the undrawn portion which needs to be included, and the CCF would be about 20% if it is more than a year, and then the applicable, if it's within 1 year, it will be 20%, more than 1 year, it will be about 50%. Market-related off-balance sheet items should take into account all market-related balance sheets items, OTC. Credit risks should be considered. Again, I'm saying more important is for every information that is received on market information, make sure that you assess this credit risk and be done with it. Market-related off-balance sheet items include interest rate contracts. If the NBFC has got foreign exchange contracts involving contracts, gold, credit default swaps, any of these gets included. The only thing which gets exempted is original maturity is 14 days or less, and there are any instruments which are on a day-to-day mark-to-market basis. Barring that, majority of this have to be assessed. Credit exposure, current credit exposure again is positive to the market value. There are various things that you need to calculate to make sure that the potential future expose is assessed in all of this. So some of these which are given here in terms of effective rather than up notional amounts, just make sure that the effectiveness is assessed as a part of it. Again, credit conversion region defaults is as a part of it. There's a computation of the net owned funds, which I'm not getting to it, but just leaving an understanding with you to know that this is a manner in which you can calculate again deferred tax calculations basis again for Tier 1, Tier 2. You need to make sure how you assess all of this. Again, important for each one of us to understand that there are these norms that we need to comply with. There's a systemically important non-deposit accepting NBFCs in terms of single borrower borrowers, infrastructure loan. These are the percentages which are given. There are certain ceilings which are not applicable, but there are certain things which are applicable with the RBI. This thing. In terms of in the planning stage, as I said, what is required for an auditor to look at it, help understand the business issues and associated risk, help identify issues that may require special assistance in the audit, help in communicating with those charged with governance, and should develop an audit scope. Again, I'm telling you today, audit is just not going to the client and they give you a financial statement or a trial balance, give notes to one, go on ticking and come back. No. Today, audit has to be complied in accordance with the standards on auditing. Every standard that goes from 100 to 200 to 300 to 400 to 500 to 600, 700, 800 All of this have to be complied in totality. That is what regulators expect, like in NEFRA. The first thing the NEFRA would say, how did you do plan? Who is an engagement partner? They'll call up the team and say, what is it? How did you do? Again, I'm telling you today, please do not do audit just just getting information to end. Do an audit a proper term with a proper nature, timing, and extent, and it becomes very, very important. It's very critical because getting an audit is not what you can be proud of, but making sure suppose somebody does and review of by regulator reviews it and says you've done an audit which is in accordance with, I think that's what we need to look at it. So our responsibilities, compliance with credit policy for sanction of loans. Please don't ignore this. Please do not say it is approved. It says everything is bada boss ne approve kar diya, board ne approve kar diya, so therefore you think it is fine. The answer is no. Make sure this appropriate compliance with credit policies of sanctions. Make sure you validate this documentation of the transaction status. Make sure these securities are created applicable. You can't say that they have a problem, somebody is not there. It's important that these are some of the things where the charges have to be created within this. Verification of systems and procedures, correctness of computation of interest and finance charges. Again, I'm saying use your tool, use your data analytics, use as such procedures which are available with you. Inspect physical assets. Don't give a client a timeline. Say that you want to have surprise visits. Do surprise visits, and that is what you need to look at it. Non-performing assets, not just the mathematical accuracy that you need to look at it. You need to really look at the qualitative aspect, the quantitative aspect of it. Look at the compliance aspect of it. Look at the adequacy of the provisions, both from standard, substandard, doubtful, and loss assets to what is required. Even for a classification greater than 1 year, 2 years, 3 years, even if it has got security, you still need to make a provisioning. So these are some things which you need to be very careful. Evergreening of loans is quite common. Restructuring of loans are common. Income tax considerations are very, very important. So look at from that perspective. Compliance with RBI norms is very important from a deposit perspective. Controls over deposits and repayments. Accuracy of interest provisioning, calculation of effective rates, and compliance of withholding taxes. In respect of borrowings, banks and institutional verification of relevant documents, accuracy of interest provisions, review of internal controls over borrowing, review of disclosures, registration of charges with ROC, and end use of funds. These are some of the things one should look at it when you are raising short-term funds for long-term purpose. These are something we need to look at it. Investments classifications. If you're under Ind AS 109, classify between held for sale to fair value through profit and loss account, fair value through other comprehensive income. It's a very important classification that you need to look at it. Because otherwise it gets into a different analysis. Ensure compliance with RBI norms, whether it's an investment policy by the firm or spelling out the criteria. Be careful in terms of the sale and purchase of a class of investments. Look at the quality nature of the where you're investing, whether the investments gets impaired the day you have invested. Look at the pledging today. In today's world, pledging of investments is becoming a big issue. Many of the large corporates are falling down because of pledging that they're using. Make sure this is what is very important. We as an auditor need to be cognizant about this. Review of board minutes, understanding of systems audit, internal audit, compliance with direct and indirect tax laws. And I think these are some things which are very, very important. Typically look at from an accounting, from impairment loans, processing, cash flow disclosure, NPA disclosures, all valuations and computations of capital to risk weighted average, income recognition, asset classification, provisioning, looking at special mention accounts, making sure that your regulations, you have this scale-based regulations. All of these is what becomes critical when you do the audit under this one. Again, I'm saying these are the tip of the icebergs. Just make sure if there are any matters that needs to be disclosed as a part of our verifications. Nothing replaces us than a proper planning, proper execution, and making sure that we comply with the laws and regulation. And it's a very, very critical aspect of it. So I'll now open up for questions and answers. If there are any questions that are coming through, I'll give it to us and we can have much more discussions on audit considerations and what needs to be done. Over to you, sir.
Thank Thank you so much, sir. Thank you so much for such a wonderful deliberation, sir. You have covered all the aspects relating to this NBFC. Sir, I have certain questions. Sir, first question is, one member is asking, can you please guide us and put some light on revenue recognition for assets scrutinized or sold out by NBFC?
It's a very important aspect of it. So when you look at it, when you sell an asset, right, the first and the foremost thing is look at from a recognition perspective. As the transfer of title is gone, that's number one. Two, look at it whether when you're doing a securitization, just make sure there is not something where there is no, especially the terms and conditions of the agreement. You have to look at the terms and condition of this thing. And the income should be realizable. It cannot be an arrangement that I've just settled it, because typically what happens in a securitization, I do it in such a way there is an income which flows to it. But if you have a history of where that the money does not get received, and this is only something where you're parking it, uncertainty, title, responsibility, and making sure that there is continuous receipt. I mean, these are certain things where there is use the word certainty rather than reasonable certainty. I'm saying certainty because when you do such thing, only then you can recognize revenue. You cannot recognize revenue merely because I've securitized an asset and therefore I would expect them. Again, you need to look at the financial condition of that entity which you have done a securitization. Make sure that there is the balance sheets are strong, and make sure there's a continuous flow of money from such entity.
Yes. Sir, another question is are the NPA classification applicable to base layer NBFCs?
NPA is applicable to everybody. So there's NPA, see again, there's only the threshold which changes. If you look at even the base, it talks about a threshold of 180 days, 8, 9, all of that. NPA is for everybody. See, it's a provisioning for doubtful debts like this. So for NBFC, NPA provision is applicable to everyone. So there is no distinction on that. See, what is an NPA? It's basically nothing but a non-performing asset on which you're not going to get your money. So what is your money? It's your interest and servicing of the principal. So therefore, NPA becomes applicable, and the prudential norms will be applicable to everyone.
Yes. So whether NCD listed company shall be deemed to listed company at par with equity listed company as per the RBI regulations and Companies Act?
So the debt listed companies, whilst they have got a reporting every 6 months, right, from that perspective, and still it falls under that because for a debt listed company, the NEFRA norms gets applicable to it. So therefore, it automatically gets into it. Again, you need to look at the thresholds relating to what extent of the debt is. And surely if it is India is applicable, then India gets it. So therefore, debt listed or equity listed, it's only with the listed stock exchanges, the complexity is less. But however, compliance is still continues to it.
Yes. Sir, whether a chartered accountant has to report in audit report about the violation of norms of leverage ratio and acceptance of intercorporate deposits for NBFC.
So if you look at, the CARO reporting, there are specific requirements under the CARO in which you need to report. But the ratios anyways have been defined for NBFCs. So you can define under the ratios, which is that even under Schedule 3, the company prepares the ratios. Now, the question is here, in terms of the loans and repayment of loans, in the manner in which you have done, that is what you need to look at it. So it is more about servicing the loans given within the stipulated, how it has got service, are there an outstanding? Those are the things that you need to bring about in respect of. So there is specific reporting which is required under the Companies Auditors Report Order 2022. Look at that aspect of it and just make sure that, especially when there are intercompany loans, whether the loans given to subsidiaries, associates, joint ventures, everything, that for purpose for which it's given, make sure that the principals and interests are regular and serviced. And if there are anything which is, let's say you already made a provision that's not received, this also gets disclosed under the Schedule 3 when you do a reporting. But from an auditor's perspective, I think you should use audit report to Instead, I would rather say that use your auditing standards to make sure that first the provisioning, if it is not done, please provide. Where you believe that such amounts are not received and where you think it's material in overall context, bring it as a part of your audit report, main audit report itself. Nothing stops you. But it should be material, it should be significant, and the nature is very, very important. Because of my not reporting, does it result into a misstatement due to an error? That is what I would need to evaluate. So when it comes to reporting, auditors have got the audit report is the basis. But this thing is more than the audit report, you should start looking at asking the company to provide. If they don't do it, qualify the report or address it as a part of your CARO if there is specific reporting.
Ji, sir. Sir, one member is asking this. Is treating CCPS as part of share capital prevailing treatment of Ind AS 109 is correct?
So you should look at it from a perspective, is Ind AS applicable to the entity? If the answer is yes, then you have to use the Ind AS 109. If the Ind AS is applicable, then the classification of the equity and debt would come through it.
Yes.
But predominantly, many of the companies have actually run into a problem. Not only the CPS, see the put option, right? Automatically, sometimes your conditions are such that to treat you into liability, and that's a huge amount. And especially when it comes to the capital to risk-weighted asset ratio, it will show way off. And if it talks about if it's CIC and then the outflow, it will be much, much more. So just be careful, mindful about this, that Ind AS applicable as a different treatment, non-Ind AS as a different treatment, right? And everything impacts your CRAR, which is your capital to risk weighted asset ratio. Just be mindful about that.
Yes, sir. Yes, sir. Sir, is there any circular or regulations or guidance note issued by NBFCs specifically that forms basis of forming lending products policies by NBFC?
No, so I would say the main principle is RBI. Okay. RBIs are the people who would be issuing all this because NBFCs, it actually gets incorporated under the companies. Unlike the Banking Regulation Act, which is separate. So unless there are specific permissions which are required for you to run, you would apply for it, for a licensing to run through it. Look for RBI circulars notifications relating to NBFC. That's one. Companies Act 2. 3, if it's listed, SEBI. 4, any other regulations that gets applicable. So therefore, my submission to it, first look at our own guidance notes are very, very, used to start with. But circulars, notifications, everything, please download it and see for each category whether it's applicable. And that's how you do it.
Yes, sir. Sir, an NBFC on which IGAP is applicable, is there any additional requirement or disclosure apart from what are the mentioned in Division 1, Schedule 3?
No, so it's only for an Ind AS where you have got statements of changes in equity and all of that. Other than that, there is not much of it. You have got CARO applicability and NBFC norm. So if it Ind AS is not applicable, the risk is very, very less. It's more about NPAs and all. But if it is an Ind AS applicable, then you have to go to the ECL provisions, fair valuation of ESOPs, impairment of assets, setting up. So there is a lot of other work and impairment of assets, fair valuation of assets, recording of assets at fair value. So there is a lot of things which you have to do if it is an Ind AS applicable. And Ind AS applicable, it is a nightmare when it comes to NBFC because you may have to set up an ECL. That means apart from your NPA provisions, you have to set up an expected credit loss at beginning itself. So the norms are much, much more stringent if it's an Ind AS applicability than a non-Ind AS applicability.
So, sir, this NPA provisioning as per the RBI guidelines is included for EACL provisioning?
Sorry?
NPA provisioning as per the RBI guidelines is included for ECL provisioning?
No. ECL is separate. ECL is, NPA follows what is called a period. 90 days, 180 days, security is there or not. ECL follows credit risk of the borrower itself. The time value of money and credit, the two aspects when you follow in ECL. For instance, I get a confirmation from the customer. What does it mean? My credit risk is protected, right? But I don't get that money for 2 years, right? There is a time value of money. So credit ECL follows credit risk as well as time value of money. Whereas NPA says, now if it is outstanding for more than, let's say, 180 days, principal and interest, you have to start doing grading provisioning, right? So, and if it is secured, there is a particular way. If it is not secured, then it's a particular way. So these are some things which, so NPA is a rule-based compliance. ECL is based upon accounting principles of credit risk, associated, and time value.
Yes. Sir, concurrent audit is not mandatory for NBFCs. Are there any specific areas where NBFC should undertake concurrent audit as a best practice?
To be very honest, internal audit should be sufficient. I think that's a very good one. Okay. Concurrent audit, see, let me tell you one thing. The objective of a concurrent audit has lost its utility. Let me be very honest with you. Some people may not agree with me. I think what has happened is that for a period in time, it became a checklist driven. Ajay, did you check cash? Did you check bank? Did you check investment? Did you check this? Did you check vote separate? That's all concurrent audit does. That is what all it is all about. So therefore, from that perspective, this is where we are driving. So we have to look at from a value add concept, because concurrent audit is never given importance in any bank or in NBFC. Internal audit is given importance because you follow a method which is, so therefore I would say follow. So if you've got complex, let's say you've got huge loans, Microsoft lending loans, let's say you have. Okay? And there are small term borrowers loans are given and their volume is high. Concurrent audit makes sense. Otherwise, concurrent audit doesn't make sense for an NBFC. I would rather believe it is important to have an internal audit, a robust internal audit, which you need to do.
Yes. Sir, in case of the big NBFC, where it has a centralized accounting system, where auditor is required to conduct top branch visits to perform any procedures?
Yes, and my suggestion is you should. You should. I think today, I'll tell you what, as an auditor, our responsibilities are far, far more than what it was. Go visit, surprise visits, ask questions, do not compromise on anything. Again, I'm telling you, who can protect you? It is only you.
Yeah.
Nobody else. So therefore, please do it. Don't tell the client. And again, sir, majority of the issues which happens in bank, sir, uska wo problem tha, sir, ye problem. Kal ko Nefra comes back and say you have not carried out. What will you say? No, sir, the banker said that he had a problem, so we have left it. What will you say? So I think we should get away from this.
Yes, sir. Sir, what can be the logic or reason for risk weight of 100% for certain assets, such as deposit with public financial institution, investments, etc.?
It's a very important point that is raised. I think, sometimes you might say there should not be any risk associated with that. So in today's world of rating, especially credit ratings that are happening, that is why the risk assessment weightages are given. So certain things have to be revisited, which the RBI has not done. They have let go of that because the reason they say there is every likelihood that the asset may not come back to you. But frankly speaking, it should be based upon rating. Again, ratings are very subjective these days. A big company which does very well suddenly turns off tomorrow. So therefore, from that perspective, that is why the weightages are given. The risk weightages are morely driven by what happens. There is a default of deposit. So therefore, at least to that issue, your capital ratio is protected. So at least there is liquidity or the capital which is protected. That is only the reason.
Yes, sir. Sir, two more questions. Yes. Sir, does the transaction of selling stressed loans to ARC leads to de-recognition of loans, or they need to be carried as it is, since significant risk and reward still remains with the NBFC who granted the loans, even if it is sold to ARC?
I'm very clear on this. Unless there is a transfer of it, they are only going to be custodian. Actually, you should own of that. I think that will come up as a part of our balance sheet also from that perspective. It doesn't get transferred. So I think, we need to still apply on that.
Yes. So one last question. So NBFC has sold its loan to ARC and in return get 85% of SR holding. Whether is it eligible for de-recognition under Ind AS?
So as I said, you have to look at the terms and the condition. What does it say? You've given 85, you have to look at it. If the risk and reward is fully transferred, then de-recognition applicable. If the risk and rewards are not transferred, no de-recognition is applicable. Well, you will still continue it as a part.
Sir, thank you, sir. Thank you so much. Now we come to an end. We have received so many queries and you have deliberated and covered all the aspects relating to NBFC. Thank you so much, sir. Once again, from the core of my heart and on behalf of AASB of ICI for acceding to our request, even of the busy schedule as well as the for official visit at the overseas and in the early morning time you are deliberating. Thank you so much, sir. Once again, thank you so much, sir, for wonderful deliberation and giving us for time, sir. Thank you so much, sir. Thank you, sir.
Thank you so much. Thank you so much for giving me. Thank you.
Thank you.